Ever since the huge financial crisis back in 2008, something really big has been happening. Kind of behind the scenes. An enormous and, yeah, potentially dangerous financial system has grown right under our noses, but almost completely out of sight. So today, we're going to pull back that curtain on this trillion-dollar world.
And that leads to the big question, right? The one that probably keeps regulators up at night. Could we be seeing history repeat itself? Well, to figure that out, we've got to do what you always do. Follow the money.
So let's set the stage. Back in 2010, once the dust had kind of settled from the last crisis, this thing called the private credit market, which is basically just lending that happens outside of regular banks, it was already worth a pretty hefty $500 billion. That's our starting point.
Now, fast forward to today. That market, it hasn't just grown, it's absolutely exploded. It's tripled in size to over $1.5 trillion. And that is the mystery we're here to unravel. I mean, where did all this cash come from? Where is it all going? And maybe most importantly, what kind of risks are building up in the shadows?
So first up, we're looking at what some are calling a hidden financial bubble. We're going to explore how this shadow banking system grew so big, so fast, all while flying under the radar of traditional rules. Okay, so let's get right into it. Let's go inside this shadow system. If we really want to understand the risks, we need to get to know the key players and, the complicated financial tools they're using.
First, you've got private debt. And honestly, you can think of this as the fuel for this entire machine. When a company is maybe a bit too risky or already has way too much debt for a normal bank to touch, they turn to these private lenders, who are, of course, chasing those bigger returns.
So what are they doing with all this borrowed money? Well, a huge chunk of it goes into something called leveraged buyouts, or LBOs. This is basically when a private equity firm decides to buy a company, but instead of using their own money, they use a massive amount of borrowed cash. And the real kicker? All that new debt gets loaded right onto the books of the company they just bought. So you might be thinking, how do these private lenders handle all this incredibly risky debt they're holding? Well, this is where the financial engineering comes in. They package it all up and sell it off using this really complex thing called a collateralized loan obligation, or a CLO. This is the engine that basically chops up the risk and spreads it all across the entire financial system. The best way to think about it is like a financial lasagna, really. You start with your bottom layer, a bunch of risky loans made to companies that are already swimming in debt. Then you bundle hundreds of these loans together. Next, you slice that big bundle into different layers. They call them tranches. The top layers are supposedly super safe, rated AAA, and the bottom layers are the really risky ones. Then you sell off all those individual slices to different investors. And just like that, through financial magic, a pile of risky loans seemingly turns into a bunch of safe, high-paying investments. The risk just disappears. Or does it? Now, if this whole structure is starting to sound a little familiar to you, well, it should. And that brings us to our next section, History's Ominous Echoes. We're about to see how today's market looks eerily similar to the conditions that led to some major financial blowups in the past. I mean, just look at this. The parallels to 2008 are, well, they're stark. Back then, the risky asset at the center of it all was subprime home mortgages, and they were packaged into something called CDOs. Today, the risky asset is these leveraged corporate loans packaged into CLOs. The warning sign back then was terrible underwriting standards. The warning sign now? It's the rise of something called covenant lite loans. The names have changed a little, but the playbook feels alarmingly familiar. And it's not just 2008. If you look back even further to the big LBO bust of the 1990s, the similarities are just as worrying. Check this out. The average amount of debt companies are taking on is almost identical, about 6 times their earnings. Back then, junk bonds were fueling the party, and a whopping 28% of those deals went bust within 5 years. Today, the fuel is these covenant-lite loans, which leaves a giant question mark hanging over the future. And that brings us to a really critical and, frankly, kind of shocking number. A staggering 89% of all the leveraged loans being made today are covenant lite. So what on earth does covenant lite even mean? Well, covenants are basically the rules of the loan. They're the safety protections for the person lending the money. Things like putting a limit on how much more debt a company can pile on. Covenant lite means those protections, they're just gone. In a market that's flooded with cash chasing deals, lenders have had to strip away these safety nets just to compete. It means they can't step in early if a company starts getting into trouble. They pretty much have to just sit there and wait for things to completely fall apart.
Okay, so we've got a system that is loaded up with a ton of debt and has been stripped of its traditional safeguards. But every bubble needs a pen, right? So what could actually trigger a crisis? Well, that brings us to our next section.
Well, a huge potential trigger is the thing we've all been feeling, the massive surge in interest rates. Between 2022 and 2024, the Federal Reserve hiked rates 11 different times. For these companies that are just loaded up with debt that has a floating interest rate, it means the cost of simply paying their bills has skyrocketed, with borrowing costs jumping all the way up to between 9 and 10%.
And that creates a massive, massive problem. There is over $1 trillion of this corporate debt that has to be refinanced by 2027. They're calling it the maturity wall. But these companies are going to have to find new loans at these new, much higher rates, and that's going to put an incredible amount of pressure on their ability to just stay afloat.
And believe it or not, the pressure doesn't stop there. You've also got ongoing trade tariffs that are raising the cost of doing business. You have supply chain problems that still haven't gone away. And you have a regulatory system that just hasn't been able to keep up with how fast this shadow market has grown. Each one of these is like another pin pushing against the side of the bubble.
Now, look, all of this might sound like some complicated, distant game that only Wall Street has to worry about. But the risks are actually a lot closer to home than you might think. And that brings us to our final and maybe most important section, why this all matters to you. So who actually owns all these risky slices of financial lasagna? It's not just high-risk hedge funds, not by a long shot. Look at this. The biggest holders are insurance companies and pension funds. We're talking about the very institutions that are supposed to be safeguarding our retirement money and paying out claims when things go wrong. All of this really leads to a pretty stark conclusion from the report this is based on. They say the feeling of safety and stability around this whole system, it's just a veneer. It's an illusion. It's a wake-up call that this ambition for super high returns has to be balanced with the simple reality that economies go up, but they also go down. And so that leaves us with the final, really pressing question. Now that we've had a look inside the shadow system, we know the risks are real, we know the historical echoes are incredibly loud. The report is warning us that the stability might just be an illusion. The real question is, are we and are our regulators watching closely enough?